Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, I'm going to talk about some really important information that John Templeton, who managed the Templeton Growth Fund for many decades, one of the most successful investors over the last several decades, and he had some words of wisdom I think we need to take to heart during times of market uncertainty and volatility. Why is that important? Well, all around us is information that creates anxiety, low-grade stress that reduces our cognitive decision making and can lead to reactive decisions that could hurt our investment success. So I think you'll enjoy this information from John Templeton's Vault of Wisdom. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on various aspects of retirement and overall wealth planning. So hit subscribe if you don't want to miss future content. As well, if you're beginning to think about retirement within 5 years or already retired and you want to get a second look at your current game plan, in the show notes you'll find a link to our retirement income planning service and how you can get a complimentary retirement planning review. Okay, let's take a look at John Templeton's investment sage advice. So one of the things that John Templeton would emphasize is how dramatic rallies can be coming out of a bear market. So as tough as bear markets are, it's vitally important that investors stay fully invested so they capture as much growth as possible coming out of a bad market. So according to Sir John Templeton, the four most expensive words an investor can say are, "This time it's different." 65 years of shifting markets have taught us two things. One, the market always recovers, and two, some of the biggest gains are made in the rally's earliest days. So the return differential between first and second 10-day periods, and this is very instructive. Let's just take a look at a few of these. So Black Monday, so that was October of 1987. I was fairly new to the industry then, and in just a few days the market dropped over 30%. So lots of volatility. However, when the market turned, and it turned before the end of the year that year, the market was up 13.75% in the first 10 days of the rally when it began. If we go back to the financial crisis in 2008, when the turn happened, in the first 10 days, the market was up 21.64%. And even if we go to COVID-19 in recent memory, March of 2020, we saw the markets go down significantly, and then they began to recover going into April, May. In the first 10 days of that recovery, we were up 19.05% in terms of capital markets. And we're looking at the U.S. market in these particular examples. So the idea here is don't lose twice. Investors who get out of the markets after a downturn and get back into the markets after a rally effectively lose twice. First by selling low, and again by missing the market's best days. It's hard to stay invested when the markets test us, but it pays to buckle up and stay the course. I'm not dismissing how difficult that can be. But if you're trying to capture as much growth as the market begins to rally, you absolutely have to be fully invested in the market so you capture those first couple of weeks in the market. Absolutely critical to be successful over time to go both good markets and bad markets. Anyway, I hope that you found that sage advice from Sir John Templeton helpful. And again, if you're new to our channel, make sure you hit subscribe so you don't miss future content. And if you are looking to get your own retirement plan, if you're 5 years out from retirement or already retired, you'd like a second opinion, go to our show notes where you can get to our website through a link there to find out how you can get your own complimentary retirement income planning review. Wishing you all the best in your retirement planning and overall wealth planning journey. You take care.